BlackRock, Vanguard, and State Street collectively manage over $25 trillion in assets. They are the largest shareholders of nearly every major corporation in America: Apple, Microsoft, Amazon, JP Morgan, Exxon, Coca-Cola, Pepsi. They own both competitors in virtually every industry. They vote on CEO pay, board members, and corporate strategy at thousands of companies simultaneously. And they got there not through hostile takeovers or Wall Street manipulation, but through the most boring financial product ever created, the index fund. In 1976, John Bogle launched the first index fund at Vanguard, the first index investment trust. Wall Street laughed. They called it Bogle's Folly. The concept was radically simple. Instead of paying expensive fund managers to pick stocks, just buy every stock in the index. The S&P 500 includes 500 major companies. An index fund buys all 500 in proportion to their market weight. No research, no trading, no genius fund manager needed. And the fees were a fraction of actively managed funds, 0.05% instead of 1 to 2%. Bogle's insight was that over long periods, most professional fund managers fail to beat the market after fees. So, why pay them? The data was overwhelming. Over any 15-year period, roughly 90% of actively managed funds underperformed their benchmark index. The simplest strategy was the best strategy. It took decades, but Bogle won. In 2019, passive index funds surpassed actively managed funds in total assets for the first time in history. As of 2025, passive funds hold roughly $15 trillion in U.S. equities. Money floods in automatically through 401k, contributions, retirement account defaults, and target date funds that allocate primarily to index funds. When you contribute to your 401k, the default investment option is almost always an index fund or target date fund built on index funds. Millions of Americans are buying shares of BlackRock, Vanguard, and State Street products without making a conscious decision. The money flows on autopilot, and with every paycheck, the Big Three's ownership stake in American corporations grows. Here's where Bogle's noble invention creates a potential unintended problem: common ownership. BlackRock, Vanguard, and State Street are simultaneously the largest shareholders of companies that are supposed to compete. They own major stakes in both United and Delta, both Coke and Pepsi, both JP Morgan and Bank of America. A controversial 2018 study published in the Journal of Finance found that airline ticket prices were 3 to 7% higher on routes where the competing airlines shared common institutional owners compared to routes where they didn't. The theory? If your biggest shareholders own both you and your competitor, the incentive to engage in aggressive price competition, which hurts profits, diminishes. Why cut prices when the same investors benefit from both companies keeping margins high? This isn't collusion in the traditional sense. It's a structural incentive that may suppress competition passively. Though economists remain divided on whether this effect is real, when you own shares through an index fund, your voting rights are exercised by the fund manager, not by you. BlackRock's investment stewardship team votes on roughly 170,000 proposals at shareholder meetings every year. Vanguard votes on thousands more. Most individual shareholders never vote their proxies. This means the Big Three exercise disproportionate influence over corporate governance, CEO compensation, board composition, executive strategy, environmental policy, political spending. A handful of stewardship analysts at each firm make decisions that shape the direction of thousands of companies. They don't own the companies. The fund investors do. But the voting power is concentrated in 3 organizations that were never elected and aren't accountable to voters. Index funds buy stocks based on market weight, not on quality. When money flows into an S&P 500 fund, it buys Apple and Microsoft proportionally more because they have the largest market caps. This creates a self-reinforcing loop. Large companies attract more passive investment, which pushes their prices higher, which increases their index weight, which attracts more investment. Meanwhile, small companies that aren't in the index receive none of this automatic capital. Critics argue this distorts price discovery, the fundamental mechanism by which markets determine what companies are actually worth. If trillions of dollars are buying stocks regardless of their value, are prices still meaningful signals? Michael Burry, who predicted the 2008 crisis, has called the passive investing bubble the next market distortion. But that's not the only way three companies can control everything. Next week, we'll explore how private equity firms use debt to buy entire industries. Before his death in 2019, John Bogle himself raised alarms about the concentration problem he helped create. He noted that if passive investing continued growing, the Big Three could eventually control voting power over the majority of American corporations. He called this an unlikely problem that might become the most significant issue in corporate governance. Bogle advocated for reforms, requiring index fund managers to pass proxy votes through to individual shareholders rather than voting the shares themselves. This would distribute the power back to millions of individual investors rather than concentrating it in three firms. The industry has not adopted this recommendation. Here's the practical reality. Index funds may still be an excellent investment vehicle for many people. Low fees, broad diversification, and long-term returns that often beat professionals. That hasn't changed. But you should be aware of what you're participating in. Every dollar you put into an index fund increases the concentration of corporate power in three firms. Every default 401k contribution adds to their voting block. Potential solutions include demanding that fund companies pass voting power back to individual shareholders, supporting antitrust scrutiny of common ownership effects, and staying informed about how your money shapes the economy beyond your own returns. John Bogle's invention was genuinely brilliant. It saved ordinary investors billions in fees and gave everyone access to market returns. But the system he created now concentrates ownership of the entire American economy in three firms. The index fund is a triumph for savers and a question mark for capitalism. This is educational content, not financial advice.